In the early decades of the United States, the idea of a powerful central bank frightened many Americans almost as much as the idea of a powerful king. The country had been born from a rebellion against distant authority. Its citizens distrusted concentrated power, inherited privilege, and institutions that seemed capable of controlling ordinary people from behind closed doors. To many farmers, craftsmen, and small merchants, a national bank represented everything the revolution had supposedly defeated: wealthy insiders, political favoritism, and decisions made far away from the communities that would suffer the consequences. And yet, the young nation desperately needed money. The United States was expanding across a vast continent. Roads had to be built. Businesses needed credit. Farmers needed loans to purchase land, tools, and livestock. Merchants needed a reliable way to pay for goods moving between cities separated by hundreds of miles. The federal government had war debts to manage, taxes to collect, and military expenses to finance. Without modern banking institutions, none of this could happen easily. In 1791, under the influence of Treasury Secretary Alexander Hamilton, Congress created the first bank of the United States. Hamilton believed that a national bank would stabilize the government's finances, support commerce, and strengthen the country's credit. The institution was privately owned but closely connected to the federal government. It held government deposits, issued banknotes, and helped regulate the activities of smaller banks. To Hamilton, the bank was a practical necessity. To his opponents, it was a dangerous concentration of power. Thomas Jefferson and James Madison feared that the bank favored merchants and investors in the cities while threatening the independence of rural Americans. They also questioned whether the Constitution gave Congress the authority to create such an institution. The debate was not simply about economics. It reflected a deeper argument over what kind of nation the United States would become. Would America be governed through strong national institutions, or would power remain closer to the states and the people? When the bank's 20-year charter expired in 1811, Congress refused to renew it. Almost immediately, the country discovered how difficult it was to finance a national emergency without a central financial institution. The War of 1812 disrupted trade, increased government spending, and placed enormous pressure on the banking system. State-chartered banks issued growing quantities of paper money, often without holding enough gold or silver to redeem it. In theory, a customer could walk into a bank, present a paper note, and demand payment in specie, the gold or silver coins that gave the note real value. In practice, many banks could not meet that promise. By 1814, banks outside New England suspended specie payments. Paper money continued to circulate, but its value became uncertain. A note issued by a respected bank in Boston might be accepted near its full value. A note issued by a distant institution in the West could be discounted heavily or refused entirely. Money no longer had one reliable value across the country. A merchant traveling from Philadelphia to Kentucky might carry a wallet filled with notes from different banks, each worth a different amount depending on where he tried to spend it. Newspapers and financial publications printed lists describing which banknotes were trustworthy and how much others should be discounted. Counterfeit notes added another layer of danger. Americans were using money, but they could not always be sure what that money was worth. The chaos helped convince Congress to establish the Second Bank of the United States in 1816. Like the first, it was designed to hold federal deposits, issue dependable currency, and restrain state banks from creating excessive amounts of paper money. But the Second Bank quickly became controversial. Its early management was weak, and its aggressive lending contributed to a speculative boom in Western land. When the bank later tightened credit and demanded repayment, the expansion collapsed. The Panic of 1819 became the first major peacetime financial crisis in American history. Banks failed. Businesses closed. Land prices fell. Families lost farms that had been purchased with borrowed money. For thousands of Americans, the suffering was not an abstract economic event. It was personal. A bank had encouraged expansion when times were good, then demanded payment when money became scarce. The institution that was supposed to create stability now appeared to have helped produce disaster. The experience strengthened public suspicion of centralized finance. That suspicion found its most powerful champion in President Andrew Jackson. Jackson saw the second bank as a privileged monopoly that served wealthy investors at the expense of ordinary citizens. Its president, Nicholas Biddle, defended the bank as an essential protector of financial stability. Biddle believed that without the institution, irresponsible state banks would flood the economy with unreliable paper currency. The conflict between the two men became known as the Bank War. It was also a battle over the meaning of American democracy. Jackson portrayed himself as the defender of farmers, workers, and small business owners. Biddle represented expertise, order, and institutional control. Jackson's supporters argued that no unelected financial organization should possess enough power to influence credit, businesses, and elections. The bank's defenders warned that destroying it would leave the economy exposed to speculation and panic. Jackson won. In 1832, he vetoed legislation that would have renewed the bank's charter. He later removed federal deposits from the institution and distributed government funds among selected state banks. When the second bank's federal charter expired in 1836, the United States once again entered an era without a central bank. At first, the new system seemed to offer opportunity. State banks multiplied. Credit became easier to obtain. Land sales increased as settlers moved westward. Entrepreneurs borrowed money to open stores, mills, transportation companies, and workshops. Local banks often knew their communities better than a distant national institution could. But the system depended on confidence. Many banks issued more notes than they could redeem in gold or silver. Loans were often secured by land whose value continued rising only as long as new buyers entered the market. State governments encouraged banks to support development projects, while speculators borrowed heavily in the belief that expansion would continue forever. America's economy was growing, but underneath that growth stood a fragile structure of paper promises. There was no national authority monitoring the entire system. There was no institution prepared to supply emergency cash when frightened depositors rushed to withdraw their money. There was no lender capable of stopping a local panic from spreading across state lines. For the moment, commerce continued. Banknotes changed hands. Wagons carried goods west. Ships entered crowded ports. New towns appeared along canals, roads, and rivers. To an observer, the decentralized system might have seemed energetic, democratic, and uniquely American. But in banking, confidence can disappear faster than wealth can be created. By 1837, falling cotton prices, tightening international credit, unstable banks, and collapsing land speculation would push the country into a severe financial crisis. America had rejected the power of a central bank. Now it was about to discover the price of having no institutions strong enough to stop a national panic. The Panic of 1837 exposed the danger hidden beneath America's rapidly expanding economy. Banks suspended payments. Businesses collapsed. Unemployment spread through cities. Farmers who had borrowed against rising land values suddenly found themselves unable to repay their debts. Cotton prices fell, credit disappeared, and the optimism of the previous decade gave way to years of hardship. The crisis did not immediately convince Americans that they needed another central bank. Instead, many concluded that the problem had been too much government interference, not too little. They believed that banking should be open to competition and controlled by state laws rather than by a powerful national institution. This idea helped create what later became known as the free banking era. Beginning in the late 1830s and expanding through the 1840s and 1850s, states passed laws allowing new banks to open without receiving individual charters from state legislatures. In theory, this made banking more democratic. A group of investors could establish a bank if it met certain legal requirements, deposited approved securities with the state, and followed rules governing its note issuance. The system encouraged growth. Banks appeared in commercial cities, farming communities, mining regions, and frontier settlements. They supplied loans to shopkeepers, railroad companies, manufacturers, and land buyers. In places where federal institutions were weak or absent, local banks became engines of development. But America still had no single national currency. Each bank issued its own paper notes, often decorated with elaborate images of eagles, ships, farmers, locomotives, or classical figures. Thousands of different designs circulated across the country. A person receiving a banknote had to decide whether the issuing bank was real, solvent, and close enough for the note to be redeemed. That judgment was rarely simple. A note from a familiar local bank might be accepted at face value. A note issued hundreds of miles away might be worth less. The farther the note traveled from its home institution, the greater the discount merchants often demanded. Special publications known as banknote reporters tried to bring order to the confusion. They listed banks, described counterfeit notes, and estimated the true market value of different currencies. Merchants, hotel owners, store clerks, and professional money brokers consulted these guides before accepting unfamiliar paper. Even with those precautions, fraud remained common. Counterfeiters reproduced legitimate notes. Dishonest bankers created institutions with impressive names, but almost no real capital. Some banks opened in remote locations, making it difficult for note holders to return and demand gold or silver. These unreliable institutions became known as wildcat banks, a phrase suggesting that some were located in places accessible only to wild animals. The exact scale of wildcat banking has often been exaggerated, but the problem was real enough to weaken public confidence. The larger weakness was structural. A bank could be perfectly honest and still fail. If too many customers demanded specie at the same time, even a well-managed institution might not have enough gold or silver available. Banks typically kept only a portion of their obligations in reserve because most customers did not request redemption at once. As long as confidence remained strong, the system functioned. When confidence disappeared, the system could collapse. Financial panic moved through the economy like a chain reaction. One bank's failure caused depositors to question another. Merchants stopped accepting uncertain notes. Businesses hoarded hard currency. Credit tightened precisely when people needed it most. There was no central authority capable of sending emergency reserves into a troubled region. There was no national lender standing behind the system. Each bank was expected to protect itself, and each community was left to endure the consequences. Yet the American economy continued to grow. Railroads stretched across the continent. Telegraph wires connected distant markets. Factories expanded. Cities such as New York, Philadelphia, Cincinnati, Chicago, and St. Louis became major commercial centers. Agricultural products moved from the interior toward eastern ports, while manufactured goods flowed westward. The economy survived because private institutions created their own methods of coordination. In New York, banks developed clearinghouses to settle payments among themselves. Instead of moving large amounts of cash between institutions every day, banks compared what they owed one another and paid only the difference. This made transactions faster and reduced the need to transport specie through crowded streets. During emergencies, clearinghouses sometimes acted like small central banks. They examined member institutions, pooled resources, and issued temporary certificates that banks could use in place of cash when reserves became scarce. These arrangements helped, but they were local and limited. They could support banks within a particular city, but they could not fully protect a national economy connected by railroads, trade, and credit. A crisis beginning in one region could still spread rapidly across the country. That weakness became clear during the Panic of 1857. The crisis began after the failure of the Ohio Life Insurance and Trust Company, a major financial institution with operations tied to Eastern markets and Western investments. News of the collapse traveled quickly through telegraph lines and newspapers. Investors became frightened. Railroad securities declined. Banks faced growing demands for cash. The economy had become more connected, but the financial system had not become more stable. New York banks suspended specie payments. Businesses failed. Workers lost their jobs. Grain prices fell, harming Western farmers. Railroad construction slowed, and confidence disappeared from markets that had seemed unstoppable only months earlier. The panic demonstrated an uncomfortable truth. America's decentralized banking system could finance expansion, but it struggled to manage contraction. It was effective at creating credit during prosperous years, yet dangerously weak when that credit had to be defended. Still, political division prevented major reform. The country was moving toward a far greater crisis, the Civil War. When war began in 1861, the federal government faced enormous financial demands. Armies had to be raised, equipped, transported, and fed. Weapons had to be manufactured. Railroads and supply networks had to be maintained. The government could no longer depend on a loose collection of state banks and inconsistent currencies. To finance the conflict, Congress authorized the issuance of United States notes, commonly known as greenbacks. These were federal paper dollars, not immediately redeemable in gold. For the first time, Americans received a widely circulating national paper currency backed by the authority of the federal government. The creation of greenbacks was revolutionary. Until then, most paper money had been issued by private banks. Now, the federal government itself was placing money directly into circulation. Congress also passed the National Banking Acts of 1863 and 1864. These laws created a system of nationally chartered banks supervised by the federal government. National banks could issue standardized notes backed by United States government bonds. The notes were designed to look more uniform and reliable than the countless varieties of state bank currency. To eliminate competition, Congress later imposed a heavy tax on notes issued by state banks. This effectively pushed most state banknotes out of circulation. America still did not have a true central bank. There was no single institution controlling reserves, adjusting the money supply, or serving as lender of last resort. But the nation now had federal currency, national bank supervision, and a more standardized financial system. The Civil War had forced reforms that decades of debate had failed to achieve. After the war, the national banking system helped create greater uniformity. A dollar issued by a national bank could circulate more easily across state lines. The federal government gained stronger control over banking standards, and the chaos of thousands of competing banknotes gradually faded. But a new problem emerged. The supply of national banknotes was tied to government bonds. This made the currency less flexible. During periods when farmers and businesses needed more cash, especially during the autumn harvest season, the money supply could not easily expand. Interest rates rose. Banks called in loans. Financial pressure increased. The system was more orderly than before, but it remained rigid. America had created national money without creating a central institution capable of managing it. That weakness would become increasingly dangerous as the United States transformed into one of the world's largest industrial economies. Railroads, steel companies, stock markets, and national corporations required enormous amounts of credit. New York became the center of a financial network reaching across the continent. But the system still depended on confidence, private cooperation, and reserves concentrated in a small number of cities. When confidence failed, the consequences became national. The panics of 1873 and 1893 closed banks, destroyed companies, and left hundreds of thousands of Americans without work. Each crisis revived the same question: how long could a modern industrial nation continue without a central bank? America had survived by improvising. It had relied on local banks, private clearinghouses, government bonds, national banknotes, and emergency measures. These solutions kept the economy moving, but none could guarantee stability. By the beginning of the 20th century, the United States had become an economic giant operating with a financial system built for an earlier age. And in 1907, that system would come dangerously close to breaking. By the opening years of the 20th century, the United States had become an industrial power. Factories filled the skylines of major cities. Steel, oil, railroads, banking, and manufacturing produced fortunes on a scale the country had never seen before. New York had become one of the world's most important financial centers, while American investment reached from Western farms to European markets. But beneath this impressive growth, the banking system remained dangerously fragile. The United States had national banks, federal currency, and a powerful Treasury Department. What it still lacked was a central institution capable of managing reserves, expanding the money supply during emergencies, and lending to banks when frightened depositors demanded cash. The system worked during ordinary times because banks trusted one another. During a panic, that trust could vanish overnight. Many banks kept part of their reserves in larger financial centers, particularly New York. New York banks, in turn, invested money in loans connected to the stock market. This system allowed capital to move efficiently during prosperous periods, but it also concentrated risk. If banks across the country suddenly demanded their reserves back, New York institutions could be forced to sell investments quickly. Falling prices would weaken more banks, creating another wave of withdrawals. The structure was modern in appearance, but unstable at its core. That instability exploded in October 1907. The crisis began with a failed attempt to manipulate the stock of the United Copper Company. A group of speculators believed they could gain control of the company's shares and force investors who had bet against the stock to buy at inflated prices. The plan collapsed. United Copper shares fell sharply, and the failure damaged the reputations of bankers connected to the operation. Depositors began withdrawing money from institutions associated with the speculators. One of the most important was the Knickerbocker Trust Company in New York. Trust companies had grown rapidly in the years before the panic. They performed many banking functions but faced fewer regulations and often kept smaller cash reserves than national banks. The Knickerbocker Trust was among the largest institutions of its kind. When nervous customers gathered outside its offices, the company faced a classic bank run. People stood in line to recover their savings before the money disappeared. The sight of one crowd created another. Rumors moved through the city. Depositors who had felt secure the previous morning suddenly feared that their bank could be next. The Knickerbocker Trust suspended operations. Its collapse sent panic through New York's financial system. Other trust companies came under pressure. Banks became reluctant to lend, even to reliable businesses. Credit markets froze. The stock market fell. Companies that depended on short-term loans struggled to meet payrolls and finance daily operations. There was no Federal Reserve to intervene. The Treasury could deposit government money into selected banks, but its resources and authority were limited. The country had no official lender of last resort capable of creating liquidity and supporting the entire financial system. Instead, the crisis placed extraordinary power in the hands of one private citizen. J. Pierpont Morgan was 70 years old in 1907. He was one of the most influential bankers in the world, known for organizing major corporations and negotiating financial agreements among some of America's wealthiest men. During the panic, Morgan effectively became the nation's emergency central banker. From his library in New York, he gathered bank presidents, trust company leaders, railroad executives, and other financiers. His staff examined the records of troubled institutions, trying to determine which firms were temporarily short of cash and which were already beyond rescue. Morgan understood that saving every institution was impossible. The goal was to prevent fear from destroying businesses that were still fundamentally sound. He persuaded bankers to contribute millions of dollars to emergency rescue funds. He coordinated support for trust companies and encouraged strong institutions to assist weaker ones. When the New York Stock Exchange faced a shortage of money so severe that it might have been forced to close, Morgan helped assemble funds to keep trading alive. The crisis continued to spread. Municipal financing weakened. Brokerage firms struggled. Banks outside New York became cautious, restricting withdrawals and reducing loans. In cities across the country, clearinghouses issued temporary certificates that acted as substitutes for cash between banks. Some businesses paid workers with checks or locally created forms of emergency currency because actual money had become scarce. The United States was one of the richest nations on earth, yet it was suffering from a shortage of usable cash. That contradiction revealed the central weakness of the financial system. America possessed enormous factories, railroads, farms, natural resources, and productive workers. The underlying economy had not disappeared. What had disappeared was confidence, and there was no public institution designed to restore it. One of the most dramatic moments came when the brokerage firm Moore and Schley faced collapse because of loans secured by shares in the Tennessee Coal, Iron, and Railroad Company. If the firm failed, it could pull several banks down with it. Morgan arranged for United States Steel to purchase Tennessee Coal and Iron. The acquisition raised antitrust concerns, so President Theodore Roosevelt had to decide whether the government would oppose the deal. Roosevelt's administration allowed it to proceed. The rescue helped prevent another major collapse, though it also demonstrated how national stability depended on private negotiations among a small group of powerful men. The panic gradually subsided. The immediate disaster had been contained, but the political consequences were only beginning. For decades, Americans had resisted central banking because they feared concentrated financial power. The Panic of 1907 exposed a disturbing alternative. Without a central bank, financial power did not disappear. It moved into private hands. An unelected Wall Street banker had been forced to decide which institutions would survive, which companies would receive assistance, and how the nation's emergency reserves would be distributed. Even many defenders of private enterprise understood that this was not a sustainable system. Congress responded by creating the National Monetary Commission in 1908. Its members studied banking systems in Europe and examined the weaknesses of American finance. Senator Nelson Aldrich of Rhode Island became one of the central figures in the reform effort. Aldrich and other financial experts believed the country needed an institution that could hold reserves, issue emergency currency, and support banks during periods of crisis. But the words central bank remained politically dangerous. Americans still remembered Andrew Jackson's bank war. Farmers in the South and West feared that a new institution would be controlled by New York financiers. Progressive reformers distrusted Wall Street and opposed any plan that appeared to give bankers more power. The challenge was not simply to create a central bank. It was to create one that Americans could accept. In 1910, a secret meeting took place at Jekyll Island, a private resort off the coast of Georgia. Aldrich and several prominent bankers and financial experts gathered there to develop a plan for banking reform. The secrecy later fueled suspicion, but the participants believed public attention would make compromise impossible. Their proposal eventually became known as the Aldrich Plan. It called for a National Reserve Association largely controlled by private banks. The plan failed to gain sufficient political support. Democrats argued that it gave too much authority to Wall Street. After Woodrow Wilson became president in 1913, banking reform took a different direction. Wilson supported a system that combined regional representation with federal oversight. The final structure created 12 regional Federal Reserve banks, supervised by a central Federal Reserve Board in Washington. The design reflected the country's long conflict between national authority and local control. It was neither a completely private institution nor a conventional government agency. On December 23, 1913, President Wilson signed the Federal Reserve Act into law. After more than a century of experimentation, conflict, and financial panic, the United States once again had a central banking system. The Federal Reserve was created to provide a more flexible currency, hold bank reserves, improve the movement of payments, and supply emergency credit during financial stress. Its creation did not end economic crises. The country would still experience recessions, bank failures, inflation, and the catastrophic Great Depression. The Federal Reserve itself would make controversial decisions and become one of the most debated institutions in American government. But 1913 marked a fundamental change. Before the Federal Reserve, America survived through adaptation. Private banks issued money. Merchants evaluated unfamiliar notes. Clearinghouses provided emergency support. The Treasury moved federal funds into troubled institutions. Powerful financiers organized private rescues when the system approached collapse. These arrangements were creative and often effective. They were also inconsistent, unequal, and unreliable. The economy survived because the country possessed extraordinary resources, constant population growth, expanding industry, and communities willing to create local solutions. It survived because Americans repeatedly rebuilt after panics destroyed banks, businesses, farms, and savings. But survival came at a high cost. The United States endured recurring financial crises in 1819, 1837, 1857, 1873, 1893, and 1907. Each panic revealed the same basic problem. When confidence failed, there was no permanent national institution with both the authority and the resources to act. The creation of the Federal Reserve was not a simple victory of experts over ignorance. It was the result of a long American argument about power. Who should control money? Should financial stability depend on government authority, private competition, local institutions, or wealthy individuals. The Federal Reserve did not fully resolve those questions. It reorganized them. The story of America before 1913 is therefore not the story of an economy operating without institutions. It is the story of a country constructing temporary institutions whenever the existing system failed. America survived without a permanent central bank because banks, clearinghouses, governments, investors, and ordinary citizens improvised. They created credit when money was scarce. They accepted unfamiliar currency when reliable dollars were unavailable. They formed private rescue networks when panic threatened entire cities. But by the 20th century, improvisation was no longer enough. The American economy had grown too large, too connected, and too important to depend on emergency meetings inside a private banker's library. In 1913, the nation finally accepted what repeated crises had demonstrated for generations. A modern economy could survive without a central bank, but it could not remain stable without something prepared to perform the central bank's role.